Generic AB Q2 2026. Generic's Q2 report boasted decent growth but declining margins year-over-year. Revenues grew 9.9%, gross profits grew 10.9%, and EBIT grew 3.3%. I was pleased to see a resurgence of the gross profit growth, but the lack of scalability was disappointing to see. The company continues to increase operational costs despite the overall modest growth over the past years. The margin hit was due to increased external costs of 32%. Management stated that the increase in costs was mostly one-time effects relating to the CFO transition, as well as costs related to evaluating business initiatives and strategic projects. I have been skeptical of the management in the past, and are skeptical about one-offs in general, but this time I am willing to give them the benefit of the doubt. Taking the increased costs as one-offs, the EBIT development is decent and the quarter overall was stellar. Looking deeper into the report, there are a couple of interesting things to highlight. The digitalization services, which mostly comprises of the important SaaS product Docs, only grew 11% in the quarter. This is down from almost 50% growth a year ago. I want this segment to grow above 20%, so the development was both surprising and disappointing. The Docs segment had basically no growth quarter over quarter. Generic only signed a single additional municipality in the quarter, which explains the poor growth in the segment. This development is cause for some concern, but could also bounce back heavily in the coming months. It was positive that the legacy business of Generic grew at a decent clip when the Docs segment had a poor quarter. Still, this makes it more difficult for investors to forecast future growth, and belief in future growth is also a bet on the management team. As I stated in my previous episode about the company, I do not yet have full confidence in management. Generic trades at a very enticing valuation compared to their opportunities, but I have not increased my position. At 40 SEK per share, the company trades at 450 million in enterprise value and a free cash flow yield of around 8%. The EV/EBIT is now approximately 11. This is very cheap if the company can go back towards scalable growth of around 10%. I still own shares in the company and find the company to be at an attractive valuation. Still, I need more quarters of stellar growth or insider buying in order to increase my position. There are question marks concerning the long-term growth of the company. Thanks for listening.